Advanced Audit and Assurance. Chapter 6. The Audit Approach. Content. 1. Audit Strategies. 2. The Business Risk Approach. 3. The System-Based Approach. 4. The Statement of Financial Position Approach. 5. Chapter Review. Introduction. Competencies. Accepting engagement and managing assignments. Analyze and evaluate the potential issues that determine the nature, scope, and extent of an assurance or audit engagement. Planning and undertaking work. Analyze, evaluate, and explain, based on a business scenario, the areas of a business that may be important to understand in order to develop an effective strategy or plan. Analyze and evaluate the techniques available to obtain an effective understanding of work being undertaken. Analyze and evaluate how risk and materiality judgments affect the planning of an assurance or audit engagement, including the nature, timing, and extent of work. Internal control assessments, including IT control. Specify and explain, in accordance with appropriate local legislation and international auditing and assurance standards, the steps and procedures for audits and assurance work in the private and public sector. Assessment of risk, internal control, internal financial controls. Analyze the role of an information technology control framework in internal control, e.g., COBIT framework. Exam context. It is critical that audit and assurance students appreciate the different strategies that can be adopted in performing an audit. In this chapter, students will gain a thorough understanding of the modern risk-based approach to auditing, which represents the fundamental approach adopted in ISAs. You will also study in some depth the system of internal controls, also very relevant to modern audit strategy. Finally, students will study the more traditional balance sheet approach. By the end of this chapter, students will be able to summarize the different types of audit strategies and factors that impact which strategy is adopted. Explain the business risk approach and be able to identify and assess business and financial risk. Describe the system-based approach and articulate the components of a system of internal control. Summarize the statement of financial position approach. Subtopic 1. Audit strategies. Section 1.1. A choice of audit strategies. An audit strategy is the overall approach that the auditor decides to take for an audit, from which a detailed audit plan can be developed. Several possible audit strategies are available. 1. A business risk approach or risk-based approach. 2. A system-based approach. 3. A substantive testing approach. 4. A statement of financial position approach, usually for small entities. These strategies are not mutually exclusive, and they may be used in combination. For example, although most of the work on a particular audit might be system-based, the auditor will also carry out some substantive testing on balances and transactions. The different approaches describe the emphasis of the audit approach and where the auditor expects to find most of the evidence that he needs to reach an audit opinion about the fair presentation or true and fair view in the financial statement. Section 1.2 Summary of available audit strategies. The main audit strategies are summarized in the following table. They will be described in more detail in the rest of the chapter. Strategies or approach and the outline of the approach. One strategy is statement of financial position approach. Outline of the approach. This audit approach concentrates on the statement of financial position figures using substantive testing, on the argument that if the opening and closing statements of financial position are accurate, then the profit or loss for the year must also be stated accurately. Number 2 strategy is substantive testing approach. Outline of the approach. This approach focuses on applying substantive tests to a large number of transactions and account balances recorded in the accounting system of the client. This focus on recorded transactions and balances. This focus on recorded transactions and balances means that understatements may not be detected. The auditor may ignore transactions that have not been recorded. This approach is time-consuming and costly for the audits of large companies. This approach is appropriate where systems and controls are weak or not operating. Substantive tests on transactions and balances are therefore necessary to reach an opinion about the financial statement. It is widely used for the audit of smaller entities where controls are likely to be weak. There is a danger of spending too much time auditing transactions or balances that are not material. There is a risk that misstatements in the financial transactions will not be detected unless all transactions and balances are tested, not just a sample. The third strategy is system-based approach. The outline of the approach are: the audit focus is on the application of test of control to the systems that produce the figures in the financial statement rather than on the figures themselves. A system-based approach is supported by some degree of substantive testing because of the unavoidable limitations or weaknesses in internal control systems. The amount of substantive testing required will depend on the auditor's judgment about the effectiveness of the internal controls. It is also supported by the use of analytical procedures. It is more cost-effective than a full substantive testing approach, but there is still a danger of doing too much unnecessary auditing of areas where controls are operating well. And the last strategy is risk-based approach and business risk approach. Outline of the approach. An assessment is made of the likelihood of material misstatements existing in each area of the audit. Areas that are assessed as high risk are audited extensively, that is, using substantive tests, a system-based approach, and analytical procedures. Areas assessed as low risk are given a low level of attention in the audit. Auditing methods applied mainly by large audit practices focus on business risk rather than overall audit risk. Section 1.3 Factors in the choice of audit strategy. The selection of the audit strategy will depend on a number of factors, including 1. The nature and size of the client's business. A business risk approach is best suited for large companies, and a statement of financial position approach is usually the most suitable for small companies. 2. The control procedures and control environment in place. A system-based approach is more suitable when there is a strong controls environment and internal control system. 3. The audit methods and techniques favored by the audit firm. For example, larger audit firms may favor a business risk approach. You may be asked to select and justify an audit strategy for a particular client in the examination, in which case students would be considering factors such as this. Subtopic 2. The business risk approach. Section 2.1. The development of audit strategy and practices. Auditing practice has developed significantly over recent years. The main reasons have been: 1. The increasing size and complexity of business units and the challenges created for the audit process by size and complexity. 2. An attempt to improve the efficiency of the audit process. The first major development in the normal audit approach was a switch from an emphasis on substantive testing to a system-based approach that concentrates much more on internal control systems and the testing of systems and controls, and normally relies much less on substantive testing. Then the concept of the risk-based audit developed. In a risk-based audit, the auditor concentrates most of the audit work on areas of high overall audit risk. As you know, audit risk is a combination of inherent risk, control risk, and detection risk. More recently, larger audit practices in particular have developed a business risk approach to audit work. Business risk is the threat that an event or development may adversely affect the ability of the entity to achieve its objectives. It is the risk of an adverse development that could have a major impact on the company's business, such as the loss of a major customer or an increase in the cost of key commodity. An adverse business event is likely to affect the company's business significantly, and so should be expected to affect its financial statement. Business risks are risks faced by management of the client entity, which could have an impact on the financial statement, including the going concern assumption. Section 2.1. The meaning of the business risk approach. The business risk approach involves the auditor looking at the business as a whole and carrying out an evaluation of the risk to which it may be exposed. The auditor identifies the business risk which may have an impact on the financial statement of the client company. The general approach is to identify the key business risk, evaluate their possible impact on the financial statements, plan the approach to the audit around the key business risks that have been identified. This approach cannot work effectively unless the auditor has a good understanding of the client's business and the environment in which it operates. Understanding the client's business and business environment is a requirement for all auditors. In ISA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. Section 2.3. The nature of the business risk approach. The business risk approach starts at an earlier stage than the conventional audit risk model, which is based on inherent risk and control risk and detection risk. By looking at the nature of the client's business, the auditor should develop an understanding of the events and circumstances that may affect the entity's ability to meet its objectives. By understanding business risk, the auditor should also develop a better understanding of the inherent risk and the control risk facing the client. The business risk approach is sometimes referred to as a top-down approach to an audit. The approach starts at the top with the business, which generates the financial transactions. The approach ends at the bottom with the financial statements, which record the outcome of the business transactions. The business drives the financial statements. This is a high-level approach to the audit and has similarities with business management and strategies. Using this approach to an audit successfully depends on having adequate and up-to-date information about the client's business and business environment. For this reason, the large auditing practices that use the business risk approach will often organize their audit teams into specialized industry groups, or may have industry experts available, or may construct specialized database for particular industries. When the auditor takes a business risk approach, he needs to be aware not only of the current position of the client's business, but also of possible future developments that may affect its goals and objectives. The auditor is interested in business risk not for its own sake, but in the light of its possible impact on the financial statement. Section 2.4 Internal Business Risk and External Business Risk. With the business risk approach, the auditor may identify key business risks for the client's company. Business risk may arise from the external environment in which a company operates or from within the company itself. External business risk. Example of external business risks might include the following. 1. The possible loss of a major contract as a result of a dispute with the customer. 2. Long-term decline in demand for the company's product and failure to invest in research and development of new products. 3. The impact of a new competitor moving into the market. 4. The impact of proposed changes in law and regulations. For example, where a company needs a license to operate, as in financial services, there may be a risk that the license will be withdrawn or will not be renewed. 5. The effect of recently discovered new technology. 6. The effect of changes in the macroeconomy, such as changes in interest rates or exchange rates, or a downturn in the economy, that is lower economic growth or possibly an economic recession. 7. The impact of natural hazards, such as storms and flooding, that may affect the company's ability to maintain operational capacity. 8. Threats from competitors to a company's patent or copyright. Internal business risk. Example of internal business risk might include the following. 1. Risk arising from ineffective employees or weak management. 2. The risk from a lack of customer care and attention to customer needs. Poor customer awareness will eventually have an effect on sales demand. 3. Poor financial management, such as excessive levels of gearing, poor cash management, and poor working capital control. 4. Lack of finance for capital expenditure on equipment replacement or modernization. 5. Risk due to system weakness or system failures, that is internal control weaknesses. 6. Risk from over-reliance on one or two key individuals. 7. The risk of fraud or the misappropriation of assets. The internal and external risk listed above are examples of risk, not a comprehensive list of business risk. In an examination question, you may be expected to identify key business risk, both external and internal, from the nature of the business and the facts given in the question. For your examination, you need the ability to read a case study or scenario and identify and explain business risks that are apparent in the information you are given, and explain how these risks have an impact on the company's ability to meet its objectives and so have an impact on the audit. Attempt your own answer to the following example before reading the answer provided. Example: business risk. Sting, a limited liability company, was incorporated in Mauritania on 1 June year 1. In July, the company exercised an exclusive right that it had been granted by the government of Sodobia to provide daily flights direct between Zob, the capital city of Zodobia, and Poleta, the main commercial city of Mauritania. The service has been widely advertised in the national newspaper of both countries as prompt, efficient, and reliable. As a result of these flights, it is expected that the traveling time between Zob and Poleta will be reduced by about 8 or 10 hours. This shortened traveling time should increase the volume of commerce and trade between the two countries. Sting operates a refurbished 30-year-old aircraft. This is leased from an international airline and registered with the Sodobian Airway Authority, that is SAA. The SAA has a strict requirement that the engines of all aircraft on its register should be overhauled every 2 years. The overhaul of an aircraft engine usually puts the aircraft out of operational activity for up to 5 weeks. The aircraft can carry 20 first class, 50 business class, and 80 economy class passengers. It also has a large hold for transporting cargo in addition to passenger luggage. On-board meals for the 3-hour journey are prepared in Zob under a contract with an airport catering company. Market research by Sting has shown that passengers are in general dissatisfied with the quality of in-flight food, especially on the Poleta to Zob flight. Sting employs 12 full-time cabin crew attendants whose training in air stewardship includes first aid training and medical procedures in the event that passengers are taken ill or injured during a flight. The captain and co-pilot for the aircraft are provided under contract by the international airline that leases the aircraft to Sting. Flight tickets are sold by Sting by telephone and at its office and airport reception desk, and by travel agents in Mauritania and Sodobia. On several occasions, there has been overbooking of economy class seats. When this happens, customers are upgraded to business class. At the moment, there is space capacity in first class and business class on all flights. Ticket prices for each class depend on several factors, such as whether the tickets are refundable, so that customers get their money back if they cancel their trip. Exchangeable, so that customers can exchange tickets on one flight for tickets on an earlier or later flight. Ticket prices also vary with the day of the week and time of the year. Sting has extensive insurance cover, including employers' liability insurance against the risk of accident to employees, and passenger liability insurance against the risk of liability to passengers for death, injury, extensive flight delays, and other risks. Required: identify and explain the business risk facing Sting. Answer: the business objective of Sting is to make profit from the provision of a daily air service between the two cities. An analysis of business risk should identify what risk exists within the business of Sting that might threaten the successful achievement of this objective, and in doing so, have an impact on the financial statement of Sting. Keyword or phrase in the text of the scenario and the business risk indicated. Keyword: exclusive right. Business risk indicated. Sting has a right to operate the flight, but there are presumably terms and conditions attached to this right that Sting must comply with. The risk is a risk of non-compliance with the terms and conditions, which might put into doubt the company's continued right to operate the flight. Keyword: exclusive right. The business risk indicated. Sting is currently operating a monopoly, but this may not always be the case, and potential future competition could significantly affect the company's business. Keyword: widely advertised as prompt, efficient, and reliable. Business risk indicated. Sting might not live up to its own advertising and might disappoint customers, affecting its business. Keyword: 30-year-old aircraft. Business risk indicated. The age of the aircraft could cause operating problems if it needs frequent repair. The relatively old age might also mean that fuel consumption and therefore cost is higher. Keyword: least. Business risk indicated. Sting will have no means of operating its service if it does not keep up the lease payment. Keyword: overhaul of an engine usually puts the aircraft out of operational activity for up to 5 weeks. Sting must have the engine overhauled regularly under the regulation of the SAA, but this will mean a break in its services as there is only one plane. Note that a case study might include information about problems that are not sufficient to justify the attention of the auditors. There are 3 examples here: the quality of in-flight food, overselling economy class tickets and having to upgrade some passengers to business class, and the need to obtain insurance. Section 2.5 Risk Evaluation. Not all risks are of equal significance. The significance of a risk to the auditor depends on 2 factors. 1. The impact that it will have on the financial statement if an adverse event occurs. It is the size of the risk. In an auditing context, this could be broadly interpreted as the materiality of the risk. 2. The likelihood or probability that an adverse event will occur so that the risk becomes reality. Auditors may use a standard model to assist them to rank risk in order of importance. The model below is widely used in management and strategy areas. It is not specifically an auditing model. So we have high likelihood or low likelihood. For high impact, the likelihood is category 1 risk. For low likelihood, it is category 2 risk. For low impact with high likelihood, that is category 3 risk. For low impact with low likelihood, that's category 4 risk. So high impact with high likelihood, category 1 risk. High impact with low likelihood, category 2 risk. While low impact with high likelihood is category 3 risk, and low impact with low likelihood is category 4 risk. Most of the emphasis in an audit will be placed on risk in category 1, where the impact of an adverse event and the probability that it will happen are both high. The least emphasis will be placed on risk in category 4 because the impact of an adverse event will be small and the probability of it happening is low. Ranking risk in category 2 and 3 in order of seriousness or priority will depend on the judgment of the auditor. Section 2.6. Advantages and disadvantages of the business risk approach. The business risk approach has some advantages and also some disadvantages. Advantages. 1. The approach requires the auditor to acquire an in-depth knowledge of the client's business. This should make the auditor more knowledgeable and able to make a better judgment about the client's financial statements. 2. When the business environment is changing rapidly, a business risk approach keeps the auditor up to date. 3. Evidence suggests that major audit problems are more likely to result from business-related problems than from internal control weaknesses. 4. A business risk approach may allow the auditor to add value by making effective recommendations to improve the performance of the client's business. 5. Audit costs may be reduced because there is less audit testing, which saves time, especially the time of junior audit staff. 6. The approach may benefit the auditor's own business because its use of a modern business risk approach may differentiate the firm's audit service from those of its competitors. Disadvantages. The business risk approach requires audit staff with suitable experience, including partners and managers. The time of these individuals is expensive. This may offset some of the cost savings mentioned above from a reduced need for junior audit staff. 2. The business risk approach requires a closer involvement by the auditor in the client's business. This may raise questions about auditor independence. 3. Some auditors feel uneasy about the broad view taken by the business risk approach and consider a system-based view to be more appropriate for reaching an opinion in the financial statement. 4. The approach may be effective only for the audit of large companies. Section 2.7. Comparison of business risk and financial statement risk. Business risk is a risk that the business entity will fail to meet its objectives. Financial statement risk is the risk that the financial statement will not give a true and fair view due to misstatement and omissions. There is normally a close connection between these two categories of risk. 1. When there is a significant business risk, failure by management to deal with the risk could affect items in the financial statement. For example, a risk from declining sales demand for a product should raise questions about the obsolescence of product inventories and the realistic useful economic life and net realizable value of the non-current assets that make the product. The going concern assumption may be challenged if the product has been a major source of income and profit in the past. 2. Weaknesses in internal control are a business risk which could result in misstatement in the financial statement. Example: business risk and financial risk. An audit team has just completed the audit of an important client. One of the risks they identified was as follows. The client's new research laboratory was threatened with closure due to failure by the company to obtain official planning permission for its construction. The laboratory was therefore constructed illegally, and there was the risk that it would have to be demolished. 1. The business risk was the risk that the laboratory would be forced to close for regulatory reasons. 2. The financial statement risk was that if this were to happen, the value of the laboratory and possibly all the equipment within it would be overstated in the account and should be written down substantially in value, possibly to €0. Both business risk and financial risk should be assessed by the auditor in order to assess the elements of the financial statement where misstatement is most likely to happen. Subtopic 3. The system-based approach. Section 3.1. The nature of a system-based approach to an audit. A system-based approach to an audit focuses on the internal control system of the client company and the adequacy of its internal controls. As part of its risk assessment exercise, the auditor is required by ISA 315 to obtain an understanding of the entity and its environment, including its internal controls. It is the responsibility of management to put in place a suitable system of internal control to address identified financial statement risk, operational risk, and compliance risk. Effective internal controls, provided that they are implemented properly, should ensure 1. Reliable financial reporting, 2. The effectiveness and efficiency of operations, 3. Compliance with appropriate laws and regulations. The effectiveness of internal controls, that is, testing the controls for effectiveness. With a system-based approach, the auditor aims to rely on the accounting system and the related internal controls to ensure that transactions are properly recorded. 1. His assumption is that if the system and the internal control are adequate, the transactions should be processed correctly, and the financial statement should therefore give a true and fair view. 2. The audit emphasis is therefore as much as possible on the systems that process the transactions rather than on the transactions themselves. Before the auditor can rely on the systems and controls that are in place, he must establish what those systems and controls are and carry out an evaluation of the effectiveness of the controls. Section 3.2. What makes an effective system of internal control? ISA 315 identifies 5 elements which together make up an internal control system. These are: 1. The control environment, 2. The entity's risk assessment process, 3. The information system, 4. Control activities, that is the internal controls, and 5. the review and monitoring of controls. Section 3.3. The control environment. The control environment is often referred to as the general attitude to internal control of management and employees in the organization. The control environment has been defined by the Institute of Internal Auditors as follows: the attitude and action of the Board of Directors and management regarding the significance of control within the organization. The control environment provides the discipline and structure for the achievement of the primary objectives of the system of internal control. The control environment includes the following elements: 1. Integrity and ethical values. 2. Management philosophy and operating style. 3. Organizational structure. 4. Assignment of authority and responsibility. 5. Human resource policies and practice. 6. Competence of personnel. A strong control environment is typically one where management shows a high level of commitment to establishing and operating sound controls. The existence of a strong control environment cannot guarantee that controls are operating effectively, but it is seen as a positive factor in the auditor's risk assessment process. Without a strong control environment, the control system as a whole is likely to be weak. Evaluating the control environment. ISA 315 requires auditors to gain an understanding of the control environment. Part of this understanding involves the auditor evaluating the control environment and assessing its effectiveness. In evaluating the control environment, the auditor should consider such factors as 1. Management participation in the control process, including participation by the Board of Directors. 2. Management commitments to a control culture. 3. The existence of an appropriate organization structure with clear divisions of authority and responsibilities. 4. An organization culture that expects ethically acceptable behavior from its managers and employees. 5. Appropriate human resource policies covering recruitment, training, development, and motivation, which reflect a commitment to quality and competence in the organization. Section 3.4. The entity's risk assessment process. With a strong system of internal control, management should identify, assess, and manage business risk on a continual basis. Significant business risks are any events or omissions that may prevent the entity from achieving its objectives. Identifying risk means recognizing the existence of risk or potential risk. Assessing the risk means deciding whether the risks are significant and possibly ranking risk in order of significance. Managing risk means developing and implementing controls and other measures to deal with those risks. ISA 315 requires the auditor to gain an understanding of these risk assessment processes used by the client company's management to the extent that those risk assessment processes may affect the financial reporting process. The quality of the risk assessment and management process within the client company can be used by the auditor to assess the overall level of audit risk. If management has no such process in place, the auditor will need to do more work on this aspect of the audit planning. Section 3.5. The information system. ISA 315 requires the auditor to gain an understanding of the business information system, including the accounting system, used by management to the extent that they may affect the financial reporting process. This aspect of the auditor's work will involve identifying and understanding the following. 1. The entity's principal business transactions. 2. How these transactions and other events relevant to the financial reporting process are captured, that is, identified and recorded by the entity. 3. The processing method, both manual and electronic, applied to those transactions. 4. The accounting records used, both manual and electronic, to support the figures appearing in the financial statement. 5. The processes used in the preparation of the financial statement. The information system therefore consists of 1. Infrastructure, that is physical and hardware components. Manual accounting system may have little infrastructure. 2. Software in IT-based accounting systems. 3. People. 4. Procedure. 5. Data. The existence of an accepted framework such as COBIT used for systems development may provide additional assurance to the auditor in the assessment of the client's information system. Illustration. COBIT. COBIT is a globally accepted suite of tools that a client might use in order to ensure IT is working effectively. Collectively, they provide a framework for integrating industry standards and good practice in the development of IT systems. COBIT is all about doing the right things the right way in order to deliver benefits to the client. The auditor should understand the development background of the client's information system to help them assess how robust it is and how strong the associated financial controls are. The key question they need to answer is whether the information system is capable of recording and maintaining accounting information that will enable a set of financial statements to be extracted that reflects the underlying transactions recorded in the system. COBIT is described in more detail in Chapter 7. Section 3.6. Control activities. Control activities are the practice and procedures other than the control environment used to ensure that the entity's objectives are achieved. They are the application of internal controls. Control activities are the specific procedures designed to prevent errors that may arise in processing information or to detect and correct errors that may arise in processing information. Categories of control activities, that is internal controls. Internal controls include the following types. In the examination, if you are asked to suggest suitable internal controls within a given system, the items in this list should provide a useful checklist. 1. Authorization controls. These require that all significant transactions must be authorized by a manager at an appropriate level in the organization. 2. Physical controls over assets. These are controls for safeguarding assets from unauthorized use or from theft or damage. An example is limiting access to inventory areas to a restricted number of authorized personnel. 3. Arithmetic control. These are checks on the arithmetic accuracy of processing. An example is checking invoices from suppliers to make sure that the amount payable has been calculated correctly. 4. Accounting controls. These are controls that are provided with accounting procedures to ensure the accuracy or completeness of records. An example is the use of control account reconciliation to check the accuracy of total trade receivables or total trade payables. 5. Management controls. These are controls applied by management. They include supervision by management of the work of subordinates, management review of performance and control reporting, including management accounting techniques such as standard setting, variance analysis, budgeting, and budgetary control. 6. Segregation of duties. This type of control is explained below. Segregation of duties. Segregation of duties means dividing the work to be done between two or more individuals so that the work done by one individual acts as a check on the work of the other. This reduces the risk of error or fraud. If several individuals are involved in the completion of an overall task, this increases the likelihood that errors will be detected when they are made. Individuals can often spot mistakes of other people more easily than they can identify their own mistakes. It is more difficult for a person to commit fraud because a colleague may identify suspicious transactions by a colleague who is trying to commit a fraud.